Gold has moved sharply higher, obviously. And as I said, it's higher than it was in May, but silver is not. An analogy I've used lots of times because I think it's valid is think of a little bit like a seesaw where, you got gold on one end, but you got copper on the other. And silver's kind of in the middle, So if gold goes up, but copper's going down at the same time, silver, which is kind of a combination, a little bit of monetary investment metal, but mostly industrial. Gold goes up, copper goes down, silver just kind of sits there. Silver to move back up. So let's watch commodities in general. Gold continues higher. And if copper makes a move back up toward $5 a pound, and some of the other industrial metals, crude oil, geopolitical reasons or whatever, crude oil starts to, trade back up toward 80 or something, silver is going to get a bid and it will rush to catch up again.
Indeed, gold investment buyers have now outnumbered sellers for 6 months, even as gold prices run to fresh record highs. But any notion that safe haven demand has pushed the market to these new record highs misses the fact that speculators in gold futures and options drive precious metals prices higher, rather than physical buyers. In his analysis, CraigHemke illustrates silver's behavior as balanced between gold and copper, likening it to a seesaw effect. With China easing and commodities like crude oil potentially climbing, he expresses confidence that silver will catch up soon. The Chinese government's stimulus measures are expected to increase manufacturing activity, supporting the metal's industrial side. This is further highlighted by Saxo Bank's projection that silver may see significant gains in 2024, targeting as high as $40 per ounce. From a technical perspective, Craig delves into the difficulty of using technical analysis when gold reaches new highs. He cites technical analyst Christopher Muon's Fibonacci extension method, predicting resistance around $2,650 to $2,675 after breaking through the $2,500 level. Reflecting on gold's movement since April, CraigHemke notes its rapid rise to over $2,600 in just a few weeks. Surprisingly, despite expectations of rate cuts and a stronger dollar, gold has continued to climb, defying regular market influences. He predicts central bank demand, driven by speculation around the BRICS summit, may fuel gold's rise. Citing data from the World Gold Council, WGC, the bank says demand for gold has been led by Russia and China, citing diversification away from dollar-denominated assets, either for macroeconomic or geopolitical reasons, de-dollarization, as a bullish factor boosting the price. Overall, demand for gold from central banks has doubled over the last 2 years, from 30 March 2021 to 30 March 2023, compared with previous years, which has had a significant impact on the price. We present the clips of CraigHemke's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We can look at a chart of silver and go back and see, what had been support and what had been resistance years ago. And we can look forward and say, okay, well, you can kind of see it might be the same now. With gold or really anything else, when it's making new all-time highs, how do you try to project, where you might run into the next resistance? And that's challenging. And so that number of 2650, 2675-ish, that came about from my discussions with a technical analyst by the name of Christopher Mullen, who, these technicians, they'll use Fibonacci, they call it Fibonacci extensions, this high to this low, and then you plot it out the same amount, and all this. And I don't know. Heck, that sounds like a good idea as anything else. And so using that method, both the weekly and the monthly chart projected, if you got through 24 and 2500, that the next major resistance would be up around 2650. And here we are. Now we moved all the way up. I think the December contract got all the way to 2708. So we moved through there. And so you might even be thinking it now as, we're pulling back and testing that level of support. But again, technical analysis when you're in this area of new all-time highs is pretty tough to do. And so it doesn't surprise me that we've kind of paused here, but gosh, things could change pretty rapidly, both economically and geopolitically in the next few days. And so, all bets are off as to where, how much further we might be able to go. If we go back to April, it's been an interesting study of things since then, because gold had tried to break out all the way back on the 1st of December last year. And then it immediately got reversed, and it took about 90 days to kind of get its act together and then blast higher. And it broke out on Friday, March the 1st, got above 2100. And then over the next 5 or 6 weeks, went all the way up to 2,400 and beyond. I mean, it was just this tremendous move. And so when we spoke back then, it had been the high, maybe it moved a little higher in May, and silver rushed to catch up. And then it was kind of like, well, we went sideways, and price came down and kind of double bottomed in the middle of June. And then boom, it blasted off, broke out again. And now here we are. Am I surprised? The surprising thing is that it has kind of gone up regardless of the normal things that might make buying or selling happen on a daily basis. When the year began, go back to New Year's Eve, everybody, the big macro strategists and economists, the Wall Street firms, were all talking about, oh, there might be 6 rate cuts. There might be 7 rate cuts from the Fed next year. And I was like, well, the Fed is saying maybe 2 or 3, and I don't see where the economy's that weak. So you figured that had to come in some, and it did. And by June, they were talking about maybe only 1. And then the dollar index was down around 100, and you figure that might bounce, and it went all the way to 107. And you would think under that environment that gold would have gone down. Instead, gold goes up and breaks out, and does all this. And so then now the Fed is starting to cut, and gold is moving even higher. One of the things I think about a lot is what am I missing? We continue to see central bank demand at very high levels, record levels for the last couple of years in a row, and that seems to be continuing this year. What could be driving this almost nonstop bid for gold? One of the things, we've got, for example, we got this BRICS summit that's coming up later this month. And there's all this speculation that they're going to announce that they're at least thinking about, establishing their own trading currency, and then that might have a gold component to it. Maybe that's it. And that, behind the scenes, all the countries that would participate in that are stockpiling their own gold reserves. That's one of those things I guess we'll only know with hindsight. But boy, what a fascinating year it has been. And we still have 90 days left to go.
Seasoned analysts like CraigHemke explain that his involvement in gold and silver stems from concerns about the end of the Great Keynesian experiment. He predicts that the growing debt and rising interest costs will become unsustainable. Highlighting the unavoidable reality of increasing deficits, Craig dismisses political promises to balance the budget as unrealistic. Trump's combination of tax cuts, tariff increases, military expansion, and mass deportations would widen budget deficits by an estimated $7.5 trillion over the next decade, according to the Committee for a Responsible Federal Budget, or CRFB. This nonpartisan group favors lower deficits. And finally, we can't ignore the U.S. national debt, which has skyrocketed from $5.77 trillion in 2000 to an eye-watering $35 trillion today. As debt rises, the risk of economic instability grows, prompting more investors to hedge with gold. However, Craig underscores that the looming economic challenges remain no matter the election outcome. One should continue investing in physical gold and silver to secure financial stability. Let's get back to the interview.
The reason I got involved in this in the first place is what we call the end of the Great Keynesian experiment, this debt-based monetary system, which works fine for a while, but the math is certain to catch up with it at some point. And that's why, where you're growing the debt and servicing the debt and the interest costs, and it just starts to go exponential in the end. And that's a mathematical certainty. And I thought, well, we got time to prepare for this. And to me, the best way to do that is owning physical gold and physical silver too. And so regardless of who wins the election, that certainty is still out there. I think it's comical that people still talk about, oh, we're going to balance the budget, and all that. No, you're not. They're never going to. That's just, come on now. You probably also notice, anybody watching either of the two debates, there were no questions about, everybody wanted to talk about, January 6th and illegal immigration, and nobody wanted to talk about the debt. It's $35.7 trillion now. The interest cost servicing that debt is over $1 trillion per year. This most recent price spike in gold began a couple of weeks ago when, in the monthly budget numbers that are reported by the U.S. government, the deficit for August, just the month of August, was $380 billion. Now, you can't take that and just, make it a run rate and annualize it and say, gosh, that's 4.5 trillion a year. Because there are some months like April when everybody's taxes are due that the deficit is sometimes even positive. But you get a headline like that and it makes people, the people that are responsible for managing money, they have a fiduciary responsibility allegedly, kind of grabs you by the lapels and shakes you a little bit. Wait a second. Did they say 380 billion for a month? We got to do something about that. And so that's not going to change. It doesn't matter who's president. It doesn't matter which party is in charge of either, side of the U.S. Congress. This is going to continue. And if we are, in fact, heading into a recession, which I have no doubt that we are, if it hasn't already begun, then your tax revenues are going to plummet. The spending is only going to increase, and that deficit and the total debt you're adding is going to widen out on an annual basis. So anyway, I have no idea who's going to win the election. But I think for people that are trying to plan for their financial security, to maintain their purchasing power, to, see their way through this storm, it's whoever wins is still, you want to keep buying your gold and buying your silver.
Gold and silver are coiling up beneath the recent highs, while convention suggests breakout risks are to the top side. The threat of a large-scale reduction in Fed rate cut bets looms large, emphasizing incoming U.S. payrolls and ISM services data to drive direction. With national debt skyrocketing and central banks increasing their gold reserves, could investing in physical gold and silver be the key to safeguarding your wealth in these uncertain times? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.